Today we're going to talk about when to be aggressive or conservative. You don't have to take the same position size or have the same goals on every trade. Learn to know the difference. Hey, be sure to subscribe on my channel and click that little alert notification bell so you get alerted when I give you more of my wisdom. What's up, Tim Sykes, Millionaire Mentor Trader here, answering your questions, going over patterns galore, seeing what works best with trading, with teaching, with the environment. I'm wearing this brand new charity merch from Save the Reef. This is one of my projects to try to save the coral reefs. Very proud to do it. And this is actually the first new merch from our fully sustainable line, recycled materials made out of plastic water bottles, and it's still comfy. Click the link below, check it out. All the profits get donated to charities working to save marine life and the oceans. I want you to get rich, but I also want you to have a planet to be able to, spend your money on. And frankly, I'm very worried about the next few years and decades if we continue to do nothing. So this might just be one shirt, and we've donated $90,000 so far, but it's a start. And it starts with awareness, no different than with learning trading. Too many people think like you have to take the same position size, you have to always go for like 20% on every trade. That's not the reality of trading. Sometimes I take bigger positions, sometimes I take smaller positions. Sometimes in my alerts and in my head, I say my goal is to make 20 to 40%. Like that's an aggressive goal. Sometimes I say, this isn't that volatile of a stock. It's not that great of a setup. My goal is to make maybe 5 to 10%. How do you know the difference? And don't get confused, okay? Don't try to make, 40% on a slow moving stock. You might miss out on an easy 5 or 7% profit. And also, if a stock has the potential to go up 40%, don't just cut profits at 5%. First of all, it's not an exact science. Sometimes you're gonna sell too soon. Sometimes you're gonna exit too early. You're trying to get in tune with what's working best in the market. So you should learn from every single trade that you do, whether you nailed it, whether you did, whether you're too aggressive, whether you're too conservative. Try to keep track of all your recent trades, and obviously it's good to keep track using Profitly. This is part of the reason why we created this software, to create full transparency, because it's not just about some BS month-end statement, where fakes lure in newbies like, look how much I made for the month, it's so easy. Actually, 90% of traders lose. Actually, it's not just about how much you make at the end of the month, it's how did you do it. Sometimes you can make a lot of money, but you're using leverage, you're partaking in risky setups. It's only a matter of time till you get burned. But a lot of newbies don't realize that. They just think a good trade is where you make the most money, a bad trade is where you lose money. And they're frankly shocked when I say sometimes a good trade is when I lose money, because I stuck to rule number one, I cut losses quickly. Or sometimes a good trade will be where I sold and I only made like 2 or 3%. And it's not that much money, but I adapted my goals because maybe it wasn't reaching my initial goals of 10 to 20%. So trading is very adaptable. You must be adaptable too. And when do I go for, bigger gains? That's a good question. Well, if it's a hot market, right now we don't really have a hot sector. Yes, the overall market is hitting new highs, but we don't have Bitcoin, we don't have marijuana stocks. Ebola stocks used to be hot, police equipment, China, nanotech, biotech, shipping, low float stocks. We've had a lot of extra hot sectors in the past few years. When those sectors are present, and you see stocks spiking 50, 100, 200% just when they add like Bitcoin to their name, or they buy a Bitcoin related subsidiary and the stock pops 300%, that's the time to be aggressive. When there are a lot of examples of similar news or similar spikes, then you can buy, the next one. That's what traders like to say, like this is the next one to go off. And sometimes it is, sometimes it's a partial next one. It doesn't necessarily spike 300%, but I never hold a stock for more than, 40 or 50%. Like my biggest gains are 40 or 50%, and that's max. So if I'm aggressive, in my playbook, I say, like in the alert, my goal is to make 20 to 40%. It's in a hot sector. Maybe it's a perfect pattern. If you click below, you can learn about morning panics. And I love morning panics. I have a blog post that I'm going to link just below this video. And there's also 800 video lessons on morning panics. So if it's a perfect morning panic, I might be aggressive with my goal. But you also have to look at the volume. Just because I'm aggressive with my goal doesn't necessarily mean that I'm going to be aggressive with my position size. What if it's a morning panic, but the volume is only like 300,000? I'm not going to take a 30,000 share position and be 10% of volume. A good rule is not to be more than 1% of volume. But let's also say, forget about just the perfect sector or the perfect pattern. What if it's just, let's say, a first green day on a former runner on an OTC? Maybe they have decent news and they have decent volume of a few million shares. I wouldn't necessarily say that it's going to spike 40%, but if I'm buying, let's say, the first green day for an overnight hold, and the stock finished at its high in this hypothetical example, and I think that it can gap up, maybe morning spike an extra 5 or 10%, I'll take it. I have no problem holding a decent to above average pattern like first green days, especially now that as I'm filming this video, first green days on former OTC runners are working very well. But just because I'm buying a stock for the first green day, usually near the market close, that doesn't necessarily mean that I'm going to hold the stock overnight. A lot of the time, these first green day winners have been running from 3 p.m. to 3:30 p.m. or 3 p.m. to 4 p.m. And then the next day, we don't get a gap up, we don't get a morning spike, and we're actually getting gap downs or morning panics. So you must adapt. I don't want you to think, oh, first green day, buy it at 3:30 p.m., always sell it the next morning. Usually, that's the pattern. But in a market where a lot of these stocks are running in the last hour and not on day two, feel free to sell. You don't have to hold the stock overnight. If the stock already hits your goals or it doesn't look like it's closing very well, just sell. You don't have to take overnight risk. This is why I love trading so much, and this is why, frankly, I want to teach you. This is just a short video. I can't teach you, all the nuances and intricacies. In fact, I'll leave a link below for my Millionaire Challenge. That's where I mentor students. That's where my top students also mentor. We give live webinars. It's a really nice community. But if you click the link below and you apply, don't just come for hot stock picks. You got to have the right mindset. You got to have the right attitude. It's all about learning and focusing on patterns, lessons, and kind of honing your skills and refining your process over time. Don't come to me if you just want hot stock picks, because that's not going to make you rich. It never is a good thing to rely on anybody else. The best thing that I can say about all my top students is that they'll like this video, but they don't need it. They've studied all my video lessons and DVDs. All my top students have been in the Millionaire Challenge. And whether you're talking about like Tim Grittani, who's now made over 9 million, or Mark Crook, who's made over 1.5 million, or Michael Good, who's made over 2 million, they don't need my alerts. They've studied enough. I'm kind of like training wheels. And that's what I want to be for you. And that's basically what this video is turning into, because I got to get going. I'm losing my voice. But I want you to understand that you can adapt and take different position sizes, big or small, and adapt based on your previous play. Like if your previous play, let's say you only made 500, but you could have made 2,000, be more aggressive on the next one. Or maybe on one play, like you cut losses and you lost like $50, but frankly the stock didn't do what you wanted, and then the same pattern pops up the next day. Either don't trade it or take a smaller position because it didn't work last time. You have to learn from every single one of your recent trades and what's going on in the market too. And also not even just the market or your trading, your own personal schedule. You might have a perfect setup, but you're about to get on a plane. That's not the time to take a big position and just trade blindly, okay? You got to think about this. All of this stuff is in my trader checklist guide. I'm going to post a link to that where there's 7 different indicators. Utilize them all. There's a thing called the Sykes sliding scale, and you can get a numerical value on different trades. Use it. Leave a comment whether you like being conservative or aggressive more. And there's no one right answer. I'm just curious. Right below, whether you're paper trading, whether you're new at trading, whether you've been trading for a lot, are you conservative or are you aggressive? I'm curious.